Hi there, Mike Brady with Generosity Wealth Management, a comprehensive, full-service wealth management firm headquartered right here in Boulder, Colorado. And today I want to talk about the lessons of 2013, or I know that it's only mid-December, but we got 11 and a half months, and I think it's close enough. But more than anything, I want to talk about the lessons I'm hoping investors don't take away from 2013. Now, before I get started, let me just say that you've heard me for a long time talk about diversified portfolios. And a diversified portfolio does not guarantee that in a generally trending down market that you will not lose money, okay? It doesn't if you have stocks and bonds and cash, okay? However, a diversified portfolio is still absolutely essential. This past year, 2013, the best thing that you could have done was have 100% in your money in the U.S. stocks, either a stock index or preponderance of individual U.S. stocks in general. Why have any of those international stocks? Or avoid bonds, okay? In general, bond ETFs or bond mutual funds in general are down single digits or maybe even double digits if you've got some long-term treasuries. If you've got a real estate investment trust, maybe you're break even for the year. So if I am an unsophisticated investor, I might say, gosh, this whole diversification thing, that's crazy. We should just look at the U.S. stock market this past year, and so for 2014, I should just have 100% of my money in the U.S. stock market. And my answer is that's the wrong lesson. Now, I happen to be bullish. You've heard me, particularly in the last 2, 3, 4 months, that because of the quantitative easing and the amount of money that's out there, etc., and some other factors, I happen to be more optimistic for 2014 than I otherwise would be. I think at least for the next couple of years, things might be okay. All right, but of course that could change. You know, as data changes, maybe my opinion changes. However, the reason why, I'm going to throw a chart up on the screen there, and I'm going to highlight the purple ones. You probably can't see it because it's kind of small, but that happens to be one unmanaged stock market index. And you'll see that in some years, 2003, 4, 5, 6, it's near the top there as one of the best performers, all the way up to 2007, and then it's the worst performer, losing well over half of its value, 53%. And then 2009, it's the best. And then it's okay for a couple years, and then it's absolutely the worst in 2011. And then it's the best in 2012. And then this past year, it's down near the bottom again. That is all over the place, but right there in the middle, you're going to see that a diversified portfolio, the asset allocation thing there, is sort of in the middle. It's never the highest, it's never really the lowest, and that's one of the things that diversification has to do. Now, if going forward into 2014, we know exactly which asset class is going to be the best one to be in. Of course, we would move 100% of our assets, but unfortunately, we never know that going forward. Okay, we can only look in the rearview mirror and say, this is the one that I wish that I had had. So beating yourself up over it doesn't help, and then taking that and assuming and extrapolating that into the next year just rarely works. Okay. Now, I'm going to throw another chart up on the screen there. And what you're going to see is over the last 62 years, so this is all the way from 1950, that green bar there on the left-hand side is the range in 1 year that some stocks in one of those years, in 62 years, when the stock market index went 51%, but also 1 year it lost 37%. Now, if it was bonds, the very best was that 43, the very worst was 8, but a combination of the two is that last one of 32 to 15. But as we go out 5 years, what you'll see is you're starting to normalize your returns and start to get lower highs, but also higher lows, which is usually what people are looking for. Now, of course, if we could have our cake and have all the high highs and, of course, the highest lows, that would be a perfect world. But when we go out 10 years and then 20 years, what you'll see is a diversified portfolio starts to get rid of some of that uncomfortableness of the huge year-by-year fluctuations, because when you have that huge decline on a 1 year, most people take that the next year will also be a huge decline. I mean, when we look back to the beginning of 2009, March of 2009, that was kind of the low for the markets after that huge, horrible fourth quarter of 2008 and the first couple months of 2009. Most people were not thinking, wow, this is the U.S. stock market is what I want to buy into. That's not what most people were thinking, but that's actually, in hindsight, the best time to buy. So what I'm hoping that people will not take away from 2013 is that diversification has no value and that it's a big joke. That is not the case. A portfolio of stocks and bonds and cash, and then, of course, other types of asset classes that surround it, historically has had the effect of reducing some of the volatility and the high highs and the low lows over time, and it creates, in my opinion, a better portfolio. One of the concerns that I have is that so many unsophisticated investors will only look at 2013 and dump all this money into 2014 into just that one asset class, which is the U.S. stock market or the unmanaged U.S. stock market indexes through an ETF or a mutual fund or an index fund or something like that, for the wrong reasons. Not because they've really thought it out, but they're going to have unrealistic expectations, and that's unfortunately probably going to come back and bite them. Maybe not in 2014, maybe not in 15, but if they come with these unrealistic expectations without a diversified portfolio, if they're wrong, if I'm wrong, they'll have nothing to stand on from a foundation, from a diversification point of view, to offset what that wrong analysis was. So anyway, that's it. Mike Brady, Generosity Wealth Management, 303-747-6455. You have a great day. Talk to you later. Bye-bye.